I'll mute right now then.
Okay. All right. I think we're good to go. Let's just one more thing here. Okay, we're good. We're good. All right. Well, good morning, everyone. Thank you for your patience. And all right. Good morning, everyone. Thank you for your patience. A little technical difficulties here to start off our second day after July 4th weekend, I suppose. My name is Vladimir Vasanets. I'm the co-founder, publisher of the registry. Very excited to have our annual San Francisco Mid-Year Broker Forum kickoff here. I think this might be our 15th year that we're doing this. We find this event to be very meaningful for the industry. First, it's a sort of nice check-in with everybody here on this panel. But second, a lot of these brokers are some of the best in the industry and really have a finger on the pulse in terms of what is happening across the San Francisco market. We're gonna tackle a few different sectors as we move along, and just for your understanding, we're going to go kind of person by person here, so I'm not going to try to engage everyone at the same time. Before we get started, I do want to say a few words and thank our sponsor, Alliance Roofing. Founded in 1986 by Rod Miller and now celebrating its 40th anniversary. Alliance Roofing has grown into the largest union roofing company in the Bay Area and a regional leader in commercial roofing and waterproofing across Northern California. From their Santa Clara headquarters, which includes an in-house metal fabrication shop, they've left their mark on some of the most recognizable projects in Silicon Valley and beyond, including work for NVIDIA, Google, Pixar, the SAP Center, and Stanford's Graduate School of Business. They handle everything from single ply, metal, and cool roofs to living roof gardens and below grade waterproofing, all backed by a 24/7 emergency leak response team. They're award winning, safety driven, and deeply committed to their clients and their communities. So grateful to have Alliance Roofing support this webinar. Thank you. All right, so I'm going to ask our panelists to introduce themselves really, really quickly. I'm gonna go, Peter, to you first. Just a couple of words. You, the company, what you do there, maybe how long you've been there, something along those lines.
Always happy to say hi. Peter Conti. I don't remember my title. I think it's National Director here at Transwestern. I run, in theory, the platform for life science for Transwestern, which is, from a niche standpoint, quite fun and especially interesting over the last couple of years. I've been here for, I want to say 10 years. It might be 11 now. I'd have to double check. But yeah.
Wonderful. Thanks, Peter. Dustin?
Yeah, thanks for having me. This is actually my fourth year for the event, so really appreciate it, Vlad. I've been doing multifamily at Colliers for 10 years now, vice chair, focused on San Francisco and the Greater Bay Area.
Wonderful. Ramsey, your colleague Roman Adler is in the room as well, so I'll have you both say hi really quickly if that's okay. Again,
Sure.
a little bit of a technical issue here, so we have the Newmark folks in one office.
No problem. So Ramsey Daya, I'm at Newmark, Executive Vice Chairman. I run the Debt and Structured Finance Group for Newmark in Northern California and the Pacific Northwest, which means we are arranging debt, preferred equity, joint venture equity throughout the capital stack on all asset classes, basically west of the Rockies for the most part.
And sorry for jumping in the back. This is Roman Adler, also at Newmark. I had some technical difficulties, but I focus on office leasing, greater downtown San Francisco. Been in the market for 21 years, so representing both landlords and tenants, and excited to have talk with you guys.
Wonderful. And Santino?
Hi, everyone. Santino DeRose. I'm a principal at Maven Commercial in San Francisco. Maven is a San Francisco-born firm. We focus on commercial real estate, but we're very well known for our retail. We work in our neighborhoods and we work in our downtown areas, and excited to participate. Thank you, Vlad.
Wonderful. Yeah. So we're going to start off here with Ramsey. The rest of you can probably turn off your cameras now for the next 15 minutes or so, and then I'm gonna call in kind of the next person as we get started. But wanted to do it like that, so we're focused essentially on one aspect of the market here. Ramsey, I thought we'd start with you because we kind of wanted to set the baseline in terms of what is going on with your side of the industry in kind of a quick maybe minute or 2 minutes. Sum up with with everything that you've seen that is shaping 2026 up to date.
I think the best place to start is hearkening back to where we were 2 to 3 years ago, when the primary question was, can I get debt for this asset? And I think where we are in 2026 isn't asking, can I get financing, but what kind of financing and how good is that financing going to be? And really what that means is our asset classes like retail really roaring back. And over the last 6 to 12 months, maybe the most exciting transition in the market has been the return to office lending. And this isn't just low leverage, no brainer trophy office lending. This is transitional office buildings. These are office refinances where just 12 or 18 months ago, some of these assets, some of these loans looked like they were in trouble. And particularly here in the Bay Area, where we have seen leasing fundamentals really start to go up and to the right and catch up to the exuberance in capital markets, that's been the real change and excitement in 26 from our perspective, is seeing that entire asset class find liquidity and footing once again.
And walk us through the return of liquidity by lender type, private credit, life companies, banks. Who's coming in hot? Is there a reason that one group may be more active than others?
So I think what we saw, again, going backwards a year or two for the participants, is we saw the securitized market, CMBS, start to catch a lot of the more challenged assets, a lot of the office assets, and some of the less anchored retail assets. So we saw CMBS move early and bring liquidity into the market. The life insurance companies have always been there. They are always there. They're still here. They're very steady. They provide great liquidity at great pricing, but they are fundamentally more conservative than any of the other any of the other lenders. What we've seen evolve in the life insurance company world is a lot of private equity firms such as KKR and Apollo and Blackstone acquiring smaller mid-market life insurance companies and put their stamp on those life insurance companies. And by that I mean they are approaching lending with a little bit more of a yield-driven mindset, where they're willing to take a little more risk to make a little bit more money. And so those life insurance companies, like we always say, aren't your mom and dad's life insurance company. Sort of life insurance 2.0, really filling a void between the traditional life insurance company and the private credit funds that we've all been reading about and who have been providing liquidity. So they're providing a little more leverage at a little higher pricing than the traditional life insurance companies. And that's been a really wonderful source of liquidity for the market, especially in the Bay Area. I think that's a nice segue to private credit. That's debt funds. You can kind of call them whatever you call them, but these are more transitional bridge lenders, debt funds, private credit funds. It depends on where you sit in the business. They're all one and the same. they are more business plan related lenders, right? Where they're willing to take risk, they're willing to fund capital, they're willing to fund higher leverage. And for all of those things, they're going to charge a higher interest rate.
Sure.
But they provide liquidity to transitional assets, to troubled assets, to assets that have a reset basis where, you know, a new sponsor's coming in with new equity to try to take a troubled asset into a stabilized core asset. And then lastly, probably the biggest change of 26 has come from the commercial banks. So we all know after the fall of FRB, Signature Bank, Silicon Valley Bank, the banks really retrenched and avoided lending for a period of time. We're very cautious. Towards the latter half of last year, we started to see the tide turn, and really January 1 of this year, it felt like the spigot reopened. So that's really wonderful to see, because we needed the banks into the market because they're providing liquidity for, you know, construction, transitional deals, stabilized deals, but they're really providing a massive source of liquidity to the market that was just gone for the last 2 or 3 years. And I think the secondary effect, the knock-on impact of the banks coming back, is they provide leverage to these private credit funds and these debt funds. So by virtue of the banks coming back, providing more leverage to the debt funds at cheaper interest rates, we've seen the debt funds get more aggressive. And so I think writ large, the upshot across all of those lending types and sources is proceeds have crept up, interest rates and borrowing rates have tightened, and we're in a really healthy market, notwithstanding a higher 10-year treasury and SOFR index rate. But from a spread compression perspective and liquidity in the market, we're in a very healthy spot right now.
Yeah, and Ramsey, it's worthwhile, noting that we are in a higher interest rate environment, but also from like a historical point of view, this is not necessarily sort of an extraordinary time, right? One would argue that maybe the last sort of 8 to 10 years were the extraordinary times. So, are you also seeing kind of the return to normal because folks are beginning to kind of accept that this is where we're heading, or where we're going to be for a while?
You hit the nail on the head, and I think it's a perspective people need to realize. We are in a higher rate environment than we were the past 8 or 10 years, but it's not too high if you can reset your basis to today's cap rates, which obviously adjust with interest rates. Rates are too high if your cap rate and your basis was set during that 8-year window of ZIRP and zero interest rates, then there's a problem. And there's really no way out of that problem other than figuring out a way to either reset your basis or do something with your asset. So as we're seeing more of these, assets return to the market to sell, reset their basis at, today's interest rates, today's market, it's a super healthy borrowing environment and lending environment for those deals.
How much of the bank freeze was the office problem sitting on their balance sheets, right? And has that cleared, or are they still kind of managing through the office issues?
The answer is yes and no. So a big chunk of that fear was related to the problematic office portfolio that a lot of these banks were sitting on. There was a knock-on effect of that, which was these banks are regulated. These banks have to reserve against loans that are troubled or viewed to be potentially troubled. And so it wasn't just a fear factor that was holding these banks back. There was real quantitative issues, right, vis-a-vis reserves and cost of capital that were impacting these banks and holding them back. And so I think there have been two things that have transpired that have got us to that point. A lot of those banks have worked through those problems, and working through those problems isn't just taking a problem to not a problem. It's marking those loans down, sort of taking the pain over the last 2 or 3 years of markdowns on their books, and effectively having the shareholders, if they're public or if they're private, but having the shareholders and having the regulators acknowledge those losses, or at least those paper losses, taking those marks, moving forward. And in markets like the Bay Area, where we are seeing leasing traction and positive fundamentals, that's really that's given banks and bankers a lot of confidence to start looking at office deals again, looking at commercial real estate again. But there was never really a concern around multifamily or industrial that was like that concern of office. So the answer is yes, that was a big drag, but it wasn't the only problem.
Yeah. Talk to us a little bit about, what is a successful deal today? And, what are the more sort of troubled ones typically look like?
Look, I think a successful deal, like I just mentioned, is first and foremost an acquisition, right, where there's fresh equity coming into a deal, so a lender can point to conviction and to that equity buffer, that's going to be anywhere between 30 and 50%, depending on where that loan cuts off. That gives lenders a lot of comfort. The reset basis and knowing that the basis that they're lending against feels good and feels like a 2026 basis, that gives a lot of comfort. And then depending on the asset class, lenders care about fundamentals, right? They care about supply. So when we're talking about apartments, one of the biggest challenges that we've seen in the Bay Area, and we'll talk about the housing shortage and the lack of housing deliveries over the last 5 years, have troubled the Bay Area, I think, from a livability standpoint. But from a lending standpoint, that is really fantastic. Because if you're lending on a newer vintage apartment building in the Bay Area, or even an older rent-controlled apartment, there's just not a lot of supply that's coming online to compete against that, right? So when you're underwriting rent growth on a multifamily asset, rent growth is a function of the wages and the rents that your tenants can pay, right? It's a function of population growth and are there enough people to rent those available units, and it's a function of supply and competing supply. Well, that last concern is really well mitigated in the Bay Area. So it's a little ironic that the fundamental problem that we're all grappling with here in terms of livability and access to affordable housing is also one of the things that a lot of lenders and buyers of multifamily are leaning on and betting on, because there's just not a lot of supply going forward. On the office side, again, reset basis, being in a submarket with transactions and traction on the leasing side. The biggest concern right now when you're talking about lending on office, advanced manufacturing, life science, any of those capital intensive asset classes is indeed just that. It's the capital intensity, right? So even at a reset basis, that basis can get really out of hand if you're offering $200, $300 tenant improvements. You add in leasing commissions, you add in, fundamental just capital work that has to be spent. And even with a really good basis, you can start getting to a really concerning basis pretty quickly in the Bay Area. So I think when you talk about what are the details and what are the functions of making a good credit play in the Bay Area on one of those capital intensive asset classes, it's really keeping an eye on your sort of peak equity or your peak capitalization.
Yeah, makes sense. As we look into kind of the remainder of 26, maybe it's too short of a time frame to see kind of any noticeable changes, but into 27 and even into beyond, are there any things that you're looking at, any things that you think might be shaping the industry?
Look, I think there is a boatload of liquidity underlying all of these lender classes. So in 25, to 26, we've seen general liquidity across banks, debt funds, life companies, CMBS, rising anywhere between 5 to 20%, right? Off of a really, really great fundamental base. So I think what we are going to see is continued growth across all of those lender classes. If there is a challenge, it's a lack of good lending opportunities. And if you talk to any lender in the market, the frustration right now isn't necessarily a lack of a lack of opportunities, but it's a lack of good opportunities. So what we have seen happen in mid 26 that we didn't see happen in mid 25 are, deals getting bid up by 15 or 20 lenders. It's turning into a fist fight for good deals, for transactions that the market likes. And it's just because there's a relatively finite amount of good deals, because again, lenders are focused on credit. I mean, you could look at 100 deals and maybe 10 or 15 of them are really good deals in the eyes of a lender. So I do think if there's a challenge going into 27, it's just a mindset that there is a lot of liquidity and debt markets are really healthy, and a lot of people are sort of looking past the fundamentals and just kind of figuring if they throw anything on the wall, it's going to stick. And that's not the point. We have not seen fundamentals and credit deteriorate, notwithstanding all of this liquidity. So there is a little bit of a mindset from developers, from brokers, that I can jam a square peg in a round hole. That hasn't happened yet. It might. If this continues, if the liquidity continues to grow and people get desperate, the next leg down is usually a credit deterioration, meaning people start looking through some of those problematic credit flaws that we haven't seen them look through yet.
Yeah, and it's interesting that you didn't mention any of the macroeconomic sort of drivers, be it inflation or unemployment or anything like that. Do you foresee any of that impacting? And sort of my final question here.
I think inflation is just is a function of the indices, and where we sit today, it's anybody's guess. I think if you talk to most people, and it ebbs and flows. 2 weeks ago, I would have told you I thought there might be a better chance of one rate hike in 26, either static rates or one more rate hike. Then we saw the jobs numbers come out last Thursday, and they were not nearly as good as the market expected. But then when you scratch and sniff those jobs numbers, unemployment is still at 4.3%. It's really good. And hiring, across certain businesses was still up. So, you see a negative, right? A negative jobs number, which could imply that maybe there could be a rate cut in the future. But then you look at these secondary readings, and they're actually still pretty good, which would lead one to think maybe the Fed can't cut in that environment. So inflation is still, in my mind, the gating item that is lurking and looming around the Fed. And we'll see what Kevin Warsh, the new Fed chairman, is willing to do. But he came out, he's pulled back. He's made it really clear he's going to be an opaque Fed governor. He's not going to give a lot of forward guidance, and the market's going to have to absorb how it's willing to accept that.
Yeah, wonderful. Ramsey, thank you so much. We're going to jump to Peter right now. Ramsey, I'm going to turn you guys off, and we'll come back in a few minutes here. Peter, just like I asked Ramsey, sum up kind of where we are here in the first half of 26. What are some of the kind of high level things that you're seeing? 60 seconds.
Go describe the market. You got 1 minute. Not to dismiss any of the other categories we're going to talk about here today, because they all have their fundamental importance. Life science has gone through one of its most interesting, convoluted, and arguably complicated kind of last 4 years in its history, but arguably in all of the real estate cycles. It was so hot, initially, and we're talking back in 2018, 19, 20 through arguably 2022. Then it hit some of its lowest points over the last 3-ish years. And the really good news is, to answer your question more directly, the fundamentals are truly much more strong, and they're back for the industry in general. That hasn't translated 100% into the real estate side of the coin yet, in the facilities, but it's getting there. And this is one of those situations where you can say, all right, we're on it. We're on the ship. The sails are now out in full, and the wind is starting to kick up from behind us and give us a tailwind. So all of the, at least leading indicators, are that we're in a much better place today than we were even 6 months ago, certainly this time last year.
Yeah, and one of those indicators, Peter, you mentioned is this XBI biotech ETF, right? Tell us a little bit about that and kind of where the numbers have been over the last few years.
Happy to. It's one of those indices that, and there's plenty. You can follow, big pharma stocks. You can follow, just venture funding. You can follow just NIH funding, kind of more at the university level, to try to get a feeling and a pulse on like where things are going. Real estate people, we tend to look very closely at vacancy rates, and there's reasons to put a lot of faith in all those things. And this is an easy like exercise for all of your viewers and people out in the audience. If you just type into Google $XBI, that is the State Street Index for the biotech market in general. And the reason it's particularly helpful is that it gives equal weighting to startups, mid caps, and kind of entrenched large pharma overall. What it kind of discounts is the money making off of current drugs. So like the big GLP-1 inhibitors that everyone talks about right now and is making Novo Nordisk and Lilly has their version. I think Merck does as well. And that's where all of their money is coming from right now. It discounts that for what's in the pipeline. Where are venture dollars being spent? Where are the acquisitions happening in the cycle and at what point during the cycle? And so it gives a lot of equal weighting and it creates a really interesting and arguably, from my perspective, really high quality picture of what the market's doing. And to get to the end of that conclusion, it's currently hovering around just over $160 a share right now. That is the highest it's ever been. Now, the last time it hit, I think it was $158 a foot. I'll go to my chart here. Yeah, January of 2021. If you look at the cycle, it was a big peak there. It came down. It was down in low levels, and now it's slowly since again the beginning of the year, come back up to those levels. That does not indicate necessarily that, again, from a real estate perspective, we're going to see this huge, enormous eruption in use in facilities. But it means all the companies that are within that cohort and in the industry are very much healthier. The money is flowing much more correctly. And therefore, again, the tailwind, so to speak, to drive the industry is a lot stronger than it's ever been certainly since 21.
Yeah, and what does this mean for M&A? What does it mean for the IPOs in this industry? Do you think it's going to be a healthy next couple of years?
It absolutely is. One of the things that's been really fun to watch is, this is a non-political statement, just a kind of a factual kind of end effect. The Inflation Reduction Act that was passed kind of during that timing put an incredible cramp on the R&D side of the coin. And the patent cliff that we've all been talking about in the industry for probably the last 10 years, which is going to be 2029, 2030, 2031, depending on which big pharma you're looking at, that pent-up demand for new technology and research hasn't faded. And so one of the really nice things is the industry itself has self-corrected, going away from oral small molecule therapies, which have a much shorter patent life now, and therefore obviously a much compressed timeline in order to make your money back. The old moniker is it takes about $1 billion in 10 years to get a drug from inception all the way through approvals and actually out to the marketplace. So if you take that timeline and the Inflation Reduction Act compressed, down to, let's call it 8 and 9 years, when you're actually able to have that patent on board, suddenly the larger molecule therapies, the injectables, the biologics, those still have that 13, 14-year horizon on them. And therefore there's, obviously got 50% more time to just make your money back and therefore profit off of it. So that's where research has gone. That's what it's targeted. That's where we're seeing a lot of the acquisition activity. I think it was Novartis, Vertex, and Ipsen just in the last quarter, 45 different acquisitions, which is that's just those 3 companies. That's not taking into account all of obviously the other ones.
Yeah, how does that compare to the past cycles in terms of them gobbling up firms?
It's the fastest it's happened in a very long time. Arguably perhaps ever. What we're seeing is that the downstream effects are really what's more interesting about that, because these companies now have free cash on hand. And they have this patent cliff, and they understand the fundamentals of what the business model is going to look like. All these mid-cap companies, your Series B, almost through phase trials or through phase trial companies with therapies, are suddenly so much more attractive. The understood business model of how to monetize that technology is so much more well-founded. What it's doing is we're just having this huge influx of M&A activity. And again, the downstream effect of that is that all the investments that are happening in the earlier stages, the seed rounds, the angel rounds, the university level kind of brand new research, all of that's now getting funded in a much more significant way. It's obvious when you think about it from a business standpoint, if you don't know that you're going to be able to get your money back out of an investment, you're not going to make the investment in the first place. That was what was holding up the markets in the last 3 years. Now that there is M&A is back, some new policies with the FTC and the DOJ have made that a little bit easier with this administration versus previous ones. That's an overall amazingly good thing for the industry to move forward, because the other side of that is once you get your money back out as a investor, you're far more likely to put a bunch of that profit you just made back into the system, seed 6 different new drugs, therapies, technologies versus just the one that you were betting on.
Yeah, talk to us about AI. Obviously, it has a lot of promise in the life science industry. How much of it have you seen being deployed, and will it hold the promise that I think many scientists hope it will?
I think AI is going to be far more significant after we have a lot of the current technologies sorted out a little bit more on the consumer level. I say that because, especially in the research world,
By current technologies, what do you mean?
we're watching, and again, pick your favorite flavor, if it's Claude or if it's ChatGPT or if it's Gemini or if it's Grok. A lot of what those companies have done really, really well so far is figure out their current technologies, SaaS models and software, or customer service facing components, or even just big research based things for a LexisNexis style, from a legal perspective or something like that.
Yep.
What we've really seen them do well so far is create searchable, real-time, analytical kind of response of current databases. Where we haven't seen AI take off just yet, but we're seeing a lot of investment on it at the ground level, is in creating new research materials. And that's where we're going to start to see, especially in the drug discovery world, interactions between molecules, interactions between biological markers and capabilities that have never been discovered before. Now, with the raw material and databases that are being built up, that will eventually pull through and create far more target sites, far more biological capabilities for both research and therefore treatment in ways that we haven't even been able to scratch just yet. Truly in the more healthcare side of the world, and I guess you could call it therefore the main pharma side of the world, where you're going to start to see, from the public's perspective, a lot more of the implementation is on the compliance paperwork side of things. So trials are going to be much more easily kind of distributed across larger populations, and all that compliance paperwork that has to go into each state, each municipality, in arguably different countries and governing bodies, that's going to become far easier for drug companies to push their own drugs through. It's also going to help fuel, therefore, that what we talked about, that M&A activity, because companies will be able to hold on to that technology far further into the life cycle of the drug, especially through those trial phases, because for a much more cheaply and much more accessibly reflected trial, they're going to be able to get the end product out and therefore hold on to that IP before they have to partner with one of the larger pharma companies.
Unpack for us some of the challenges in the life science industry today, especially what it means for the real estate folks, whether it's development owners, folks like that.
Well, the challenge is on a couple of different fronts. One of which is it was just a simple quirk of bad timing, for lack of a better way of putting it, and therefore bad luck. We have amazing amounts of high quality, fundamental developments up and down, certainly San Francisco, going down the peninsula, in the East Bay as well. There's lots of availability, lots of square footage. The problem is a lot of these buildings that were created, and again, hats off to a lot of the developers who took big swings and were constructing beautiful new projects with lots of square footage. Fundamentally, these are great buildings. They have high power, they have high ceilings, they have loads of sterile air capabilities, shipping, receiving. The things that made buildings fundamentally broken leading up to in 2019, 2020, especially in some of the kind of slapdash conversions that we saw, those issues have more been teased out. And so now you have the major developers doing really high quality work. The problem is that the companies that are getting funding right now and do need their expansion, they're looking at these buildings that are in some sort of shell condition, be it warm or cold, and therefore it's a very expensive bill in order to build out, and it's going to take 2+ years to do so in a lot of cases, given the specificity. Well, as we all know from a lot of how venture works, you get your funding round, and that's for immediate scale. You don't have 2 years to wait to eventually start hiring people and eventually get that drug, furthered through its process. You have 90 days because your next round of funding has to come within that 2-year period. So there's a lot of availability that's, again, very high quality, but it's going to sit there and it's going to be a little bit locked up until we start getting a little bit more proactive and a little bit more speculative on the real estate side and the ability to unlock it for those use cases. It therefore creates this kind of weird nexus where the space that is plug and play and available right now is at an incredible premium over the stuff that you could, sign a long-term deal and have it customized to yourself. You just got to be able to wait that out. And what we haven't seen in this current funding cycle and what XBI obviously is showcasing is that the big major players in terms of the Fortune, call it 100 pharma companies, where they're not spending their money right now is on facility expansion. They're spending it on acquisition. And all those acquisitions generally come with their own facilities currently. And so it's not really within their business plan to start doing that just yet.
Yeah, I guess the one positive aspect of that is that when an acquisition happens, you're not seeing a reduction in space necessarily, correct?
Correct. You kind of do to a certain extent as a
Right.
very tailing end of that, in part because it would make perfect sense. You don't need to duplicate your legal department, your marketing department, your sales department, your compliance people, and stuff like that. You might for a while, but eventually, once that
but
drug is
that's more of an
fully-
office sort of product anyway, right?
yeah.
For that kind of back office stuff.
Correct. But from an R&D perspective, it's all the same things. You don't need quality control replicated twice as many times just because you have a new IP inside your walls.
Yeah, makes sense. In the last cycle, the industry geographically has expanded. We've seen some growth on the peninsula. So the typical markets of Mission Bay, South San Francisco, and Emeryville, and that kind of thing. We're seeing some stuff pop up in Berkeley also. Run us through kind of what you think where some of the hotter markets are in the region.
In the region, we're starting to see the growth truly at the main addresses of the previous cycles. It's no surprise that in places like, we'll say Palo Alto, Redwood City, especially next to where that venture capital is flowing from on Sand Hill Road, in some of the major players, you're starting to see the growth hit there far faster than some of the, I don't want to call them secondary or tertiary markets, but let's say slightly more edge cases. That's great news for South San Francisco. That's great news for kind of the Berkeley-Emeryville corridor. That's great news for, as I mentioned, call it the Redwood City, San Carlos, Palo Alto sections. It's not super news necessarily yet for the Haywards of the world or the Richmonds of the world or even San Jose's of the world. They're next, and larger format use cases, especially for slightly less complicated, maybe more production-oriented uses, are coming. They just haven't quite hit just yet in the same way.
My final question here, crystal ball for us, if you will. Where would you put dollars today? Which subsector is most catalytic, you think, in the market?
Oh man! Every time I answer this,
It changes.
I get a lot of private messages after the fact because as is obvious, people want to invest in this sector. It's incredibly hopeful. Anytime you're dealing with health and the way to improve health and longevity, people are interested. I'd say that the antibody drug conjugates, the ADCs, that are kind of newly being researched and brought to market, those are unbelievably complicated but effective. And so these large molecule cancer treatments that had previously been, I don't want to say a little more simplistic, and especially from the oral small molecules that were kind of yesteryear, the new ones are incredibly effective. The dual to triple payloads that these ADCs can therefore deliver, which basically means you can lower the dosage and therefore the lethality of whichever one drug you're trying to deliver because you have not just one, but 2 or 3 on that same payload. So they're attacking the same tumor problem from a couple different directions. It means the survivability and the efficacy goes up, but again, the toxicity and therefore all the side effects that to the patient go way down. That is absolutely the biggest thing I'd say right now in the research and kind of cancer world. we're seeing longevity and health, especially in the mental capability, intellectual capability, see a real big resurgence. Obviously, as we have a boomer population aging into more kind of static requirements from their health perspective, keeping your wits about you, keeping your eyesight, keeping your brain health high, keeping your longevity and therefore just your enzymatic capabilities within your own body high and functioning. Those are also seeing a lot of not just investment from the VC community, but also like those are the drugs that are being acquired going forward as well.
Wonderful. Peter, always a pleasure. Thank you for this awesome summary. I know there's so much we can talk about here.
We could go for hours.
We could go for hours.
We have
exactly.
some other very good people to talk about other sectors. Yeah.
Wonderful. We're gonna go to Dustin now. So thanks again, Peter, and we'll speak soon. Dustin, good to see you again. Multifamily. So I'm going to start with you like I started with everybody so far. Give us, a 60-second, overview of kind of where we are here midway through 2026.
Yeah, thanks for having me back. The exciting thing is I get to be very optimistic this year. Some of the past years was a little bit different. I would say, looking back, we now realize 2024 was the bottom. 2025 was a big recovery, and 2026 continues to surpass that. Last year, rents grew by 10%. This year, we're already at 15% citywide.
Highest in the country, we should mention, right? Is this accurate?
Highest in the country, highest rent per square foot. New York has some higher end product, doorman and stuff like that. But if you're looking at just overall rent growth in the nation, San Francisco's at the top. And then on top of that, transaction volumes increased dramatically. Transaction volumes up 25% in the last 12 months. That's because of an inflow of institutional capital. And I think the big reason for that is if you look at where you're going to place money in the United States, you have New York with rent growth, you have Chicago, Seattle, and San Francisco. New York, from a political standpoint, is making it very restrictive for landlords. They have a vacancy tax. They just did a rent freeze on rent stabilized product for 2 years. So if you're a capital allocator, you're pretty much gravitating towards the Bay Area. And then San Francisco is kind of seen as the creme de la creme in that opportunity. So we've gone from 50% of our transactions being mom and pop investors in 2024 to now 80% of the transactions being institutional or quasi-institutional investors.
Yeah, the one thing you mentioned in our prep call was that the missing middle, it was kind of the only part of this story that maybe hasn't seen some of the growth. Is that correct?
Yeah, I would say multifamily feeds off people being in the city, and as people come to work, they want to be close to their offices, or if they're working from home, they want to be in the areas that are seeing more of a premium. So that's going to be the north part of town, avenues where you can get a house. North Beach is very popular, and then Soma Dogpatch with the new construction. The Class B office space, which I'll let the office guys take this, but a lot of that product has been unrentable. That's where Twitter used to be. And we used to sell buildings in the Tenderloin where people working at Twitter were paying $2,300 for a studio. Those studios are still $1,500, $1,600. So I'd say everything else is recovered post pre-pandemic to be at higher rents, but that missing middle kind of market adjacent market quarter hasn't caught up yet.
We've seen some stories that some of the tech companies have been paying their employees higher salaries or bonuses to live closer to the office. So I guess this will be the only sort of cross reference that we'll make to the office sector. But curious if you're seeing that in rent growth also and also in the valuations.
Definitely. I think the most interesting stat is in 2019, which we call the peak in our multifamily market, renters were spending about 32% of their income on rent. What's happened is COVID hit, rents dropped by 30%, but wages kept growing. And so now, although rents are surpassed pre-COVID levels, people are only spending 24% of their income on rent. So if you're a believer in the Bay Area and you're an investor, you're basically saying, despite how high some of these rents are, people have the financial ability to take on more of a burden for rent. Even though 30% is a drastic amount of money to spend on your income, or on your rent, people have done it before. And so investors, whether it be the large institution or local investors, feel like they have a lot of runway. The interesting thing is too is the population in San Francisco has been unchanged since COVID. We're still about 100 to 70,000 people light on people coming back to the city. So if you're a believer that people can spend more money on rent and we have another 70,000 to 100,000 people that haven't moved back, you're going to see these rents continue to grow for the next couple of years.
How has the pricing per unit been evolving? You know, Class A, Class B, Class C. Have you seen growth there as well?
Definitely, I'd say at the bottom for rent control products, we were down to 350 a door. That's closer to 500 a door. And then new construction, we're seeing some of the nicer product get into the 600, 700, 800 a door, depending on where it is. We're starting to see our first sub 4 caps in the market. Now, a lot of those are going to be in new construction deals where you can capture the rent growth moving forward. But I would say at the peak, our average cap rate was 6%. And on average now we're 5 or maybe just sub 5 in the market. So about 100 basis points.
Yeah, and Ramsey talked about that in the market. What are you seeing in terms of, you know, lending and equity coming in? Obviously, you know, just for San Francisco, but I'm curious, sort of, what are some of the drivers there?
First Republic was a big loss for us, and we've talked about that in years past. Citizens has really stepped into the fold and taken on that for the private client, as has Chase. So that's been big for the high net worth families, the private clients. On the more institutional side, debt funds continue to be the most aggressive. I mean, we'll do a lot of agency stuff, working with people like Ramsey or other debt teams, but we've seen the debt funds get the most aggressive just because they're pricing in a lot of future rent growth. And they'll lean in on the LTV and the debt coverage ratio to capture that moving forward.
Interesting. So they're pricing in debt rent growth. Do you think that's sustainable?
I mean, you talk to a lot of people, they're underwriting 5% rent growth for the next 3 or 4 years. I mean, I love it. It's great for my role. We'll see if we capture it, but it's
Right.
tough. It's tough to doubt it, right? We're only delivering 4,000 units over the next 3 years. And if you're telling me 100,000 people are going to move to San Francisco, they have 10%, they have wage growth that they're going to get where they can capture higher rent. I don't see how the rents don't grow because we're just not delivering enough units.
Yeah, no, that is very true. Um, uh, what about construction? What about new sort of development? Are you seeing, you know, folks trying to, you know, figure that out? Um, where's the industry there?
It's been pretty light. There's a big development getting delivered at 1111 Sutter, which is going to be 300 doors. That's probably the biggest project that's, you know, they've already built the infrastructure. If you drive by Sutter, they got steel in the ground. Other than that, it's been pretty light. So 4,000 units in the next 3 years. If you ask the city, there's 75,000 units in the pipeline, but that's anybody who's submitted plans, is filing for permits. And a lot of the housing product that I see people building are little 5 or 6 unit deals with an ADU in the back. It's not the big projects that we need to capture a lot of homes. So I think if you're an owner or a capital placer, San Francisco has very little risk from competition, especially in the neighborhoods where there's already a built out area and there's no gas station corners for you to develop. There's not going to be a lot of competition.
Yeah. So let me then ask the obvious question here. Are we beginning to see a spillover into Oakland and some of the other markets, you know, surrounding the city?
Definitely. It's happening. So Oakland to San Francisco, typically there's about a 25% rent premium for San Francisco. That's grown to the highest level ever. It's 60%. So we're getting to the point where we're starting to hear from leasing agents and from investors who are starting to turn their eyes into Oakland. Oakland's now starting to get positive trade outs on a lot of the new construction stuff. I would say concessions are down to 1 month at most, and delinquency is pretty much burned off across a lot of people's portfolios. So I think it's the logical move for renters to start to move to Oakland, and we're already seeing big investors plant a flag there, just because you can get new construction stuff in Oakland for still 300 a door. You know, I'm selling stuff downtown adjacent that's rent control built in the 1920s for over 300 a door. So it makes sense for people to go there. And I think you see Oakland probably this year and next year experience similar rent growth to San Francisco.
Oh, interesting. Tell us a little bit about the investor profile. Like, has that evolved? Have you seen that change at all, or is it sort of indicative of kind of where we are in the cycle? Is it similar to what we've seen in the past?
The nice thing is, and this sort of goes to the politics in San Francisco, I think one of the biggest hurdles that we would overcome from new entrants, whether it be pension funds or private equity groups, they would always ask, what's the political risk? We've had a lot of legislation in the last 7 years around vacancy control and other punitive measures for landlords. Those have ultimately not passed. And Lurie has seemed to have set the table in the new board of supervisors to say, hey, this is the landscape. We want to protect tenants, but these are the rules of engagement. And we're going to keep these rules of engagement for the foreseeable future. And that just helps people underwrite. You go to New York and you buy a building and then they say your rents are frozen for 2 years. That makes it really hard for an investor to be confident to write a check. We now have in the San Francisco and the Bay Area as a whole what seems like smooth sailing from just any new laws. And they've even turned to think about lowering the transfer tax, which would be pro landlord. So I think to answer your question, new capital is coming in that would tell me and my team, hey, we're just not really sure about the political risk. They seem comfortable with making the investment. And I think that further pushes pricing in the city.
Yeah. Is there anything that you foresee from the mayor's office? I mean, I know they're very anxious to get some of these, projects going, and you said there's a lot of them, but not necessarily, anyone breaking ground. Have you seen anything else from the city where it's really trying to kind of get movement into the industry?
They're trying. I mean, they've done everything from, and the office guys would know this better, providing grants and whatnot to help convert office into multifamily. I think there's kind of a disconnect between the government and investors as to what return investors really need to put a shovel in the ground. You're taking a lot of risk. So I think we're still a ways away. I will say rents now support building a lot of these projects. So the rent issue has now been solved. Now it's, hey, can these developers buy the land that they want to buy to make the deals work? So the rents have been satisfied. Now we just need people to get the right projects and the city to support them.
If some of the macroeconomic trends that we may experience later this year, whether interest rates go up, inflation continues to go up, I mean, what does that do to the industry in San Francisco for multifamily?
I mean, I think we're pretty insulated. I think as long as inflation doesn't jump to an extent where the treasuries move very, very dramatically, I think we'll continue to be able to get favorable debt. A lot of the stuff we're selling is at cap rates below treasuries right now. So it's not like people won't stomach negative leverage. The biggest risk to investors is the rent growth. If the rent growth story slows down in year 2 or 3, that's what's buoying this whole market. But I think the fundamentals are really supporting a long-term growth period of rents in the Bay Area and San Francisco.
Dustin, my last question for you, as you look into the rest of the year, 2026 and into 27, what are you looking at? What are some of the things that are most important for you to note?
Yeah, I think the big thing is following rent growth. We're going to be keeping close tabs on that. I think for the rent control product is how many of these tenants are actually moving. Turnover is a big thing, and when you have someone who gets to such an extent below market, what do those turnover percentages look like? Typically in a building, it's about 30%. Do those start to scrunch a little bit closer to 25, or are these renters making so much money that they still have the upward mobility to go buy a home or a condo, which has historically been the case? And then just general interest rates. If interest rates really start to blow out, we're going to have to reconfigure our cap rate expectations. But I think it's smooth sailing.
All right. You are very optimistic, Dustin.
I have to be.
Yeah, absolutely. Well, thank you again. Very good to hear from you. Santino, we're going to go over to you now. So, Dustin, we'll talk soon. All right. Santino, how are you? Okay, so just like everyone else so far, I'm going to ask you to give us kind of a quick 60-second overview of where we are in 26. What are some of the big things driving the retail market in San Francisco?
Sure. Well, the 1 minute overview is probably that we spent the last 5 to 7 years watching our retail go into our neighborhoods. Our neighborhoods are full. Our neighborhoods are thriving, and we're seeing we have a lot of demand for neighborhood space with not a whole lot of supply. Our high traffic retail corridors are all under 5% vacancy, and what that's resulting in a lot of people taking another look downtown. So we're diligently working downtown, and we have a lot of activity downtown, financial district, along our waterfront, and other areas.
Yeah. So let's jump into that. Tell us, what makes San Francisco retail scene different, now compared to, a few years ago. I mean, you mentioned that a little bit, but also, give us an overview of some of those markets or submarkets rather that are very active, and what are the drivers?
Well, to your first question, what makes San Francisco's retail different? We're not a city of big boxes and shopping malls. We are driven by independent operators. There's a demand for space from national tenants. We're highly dependent on our locals, but we're also highly dependent on tourism. We have about 24 million tourists a year that spend over $5 billion a year on our retail.
And we see those numbers go up and down for 26 and 27. Are we back kind of in the pre-COVID numbers for that?
Our spending is back at about even, maybe a little higher. Our tourism numbers are expected to be higher than pre-COVID. 29%, I think it's 29% of our flights coming to SFO are from international visitors. To give you a sense, our total visitor spending is $10 billion, and out of that $10 billion, half of it is international. So we're highly dependent on international tourism, and there's no new retail being built in San Francisco. So financially, as our colleagues on this call will tell you, there's residential that's being built and office, etc. But there's not a whole lot of retail. We sort of have what we have, and when absorption hits, it really makes an impact. What did you ask about? Different neighborhoods?
Yeah, kind of an overview of what's happening, as we look at, Financial District, Union Square, other sort of submarkets.
Yeah, well, Financial District, Union Square, we obviously were hit hard over the last few years on vacancy. We've seen a lot of the retail get absorbed. A lot of the smaller spaces were absorbed. There were a lot of people that stood on the sidelines, but there were also a lot of people that took the opportunities and really made sense of them. Resurgence is often sparked by food and beverage. And food and beverage in Union Square and our financial district is challenging because of cost. Because of infrastructure. Putting a vent into a space that goes up however many stories is not cheap. Construction costs are not cheap, and second generation spaces tend to be the first to go, and we still have a few lingering in those areas.
Does that concern you? Are you worried that some of the food and beverage operators may not be able to survive or be as profitable as they maybe were in the past?
I mean, food and beverage is a very challenging business. I think any restaurateur will tell you that. That said, we're seeing some trends in San Francisco with food and beverage. We're seeing our bigger restaurants become popular. The Original Joe's, North Beach Restaurant, Arquette that just opened and is doing well. There's that demand for bigger space. Wayfair Tavern, Pine Street in the Financial District has really hit some highs with Wayfair and Crustacean, and then California just brought in Turtle Tower. Perbaco's back, so we're excited to see our restaurateurs back. In terms of cuisine, we're heavily influenced by Asian concepts. Korean is really surged in terms of interest. I'm trying to think what Dalida, which is Middle Eastern, Turkish, Lebanese concept has been great. Indian with Copra, Greek is popular. So we're not seeing your typical French and Italian Californios, which is more California Mexican. Had just got an additional Michelin star. So we're seeing a more global cuisine, which is great. It is, and we're elevating our food. We're getting back into that competition, into the awards and the fine dining that we've always been known for.
Yeah. When we talked last week in preparation for this call, one of the things you mentioned was the neighborhoods were kind of the surprise story. Some vacancy in certain neighborhoods is under 2%. Where is this demand strongest, and why do you think that these neighborhoods are doing really, really well?
Well, there's certain neighborhoods. There are a couple neighborhoods in specific where COVID was actually that whole the neighborhoods flourished during COVID during the pandemic. That was North Beach, which is really one of the hottest neighborhoods in the city right now in terms of food and beverage, retail, whatever. I mean, people want to be in North Beach, and then Chestnut Street. Chestnut Street and the Marina actually saw rents increase during the pandemic, where other neighborhoods obviously saw a drop. But I would say Chestnut and North Beach benefited the most. We're seeing quite a change on Fillmore Street right now with new food and beverage coming in, a big demand from retail that wants to come in, and just a finite number of locations. But yeah, a lot of areas under 5%, Fillmore, Chestnut, Sacramento Street. Jackson Square is another major hub for new retail. Castro, which had a lot of vacancy, is now close to 5%. So it's great. It's great for the neighborhood, keeps people in their neighborhood, supporting their neighborhood, and draws visitors to the neighborhood.
Yeah, and what kind of retailers are we seeing that are going into these hot spots?
Neighborhoods are general. The neighborhoods. Fillmore is a lot of emerging brands. Maybe I wouldn't call them national brands, but brands that do have multiple locations. Same with Chestnut. Fillmore, we're seeing new food and beverage concepts that are coming in. Same with Chestnut, North Beach, and so on. And then downtown, we're seeing, I would say, luxury is a little bit on the sideline in comparison to where it was a few years ago. We're seeing more fast fashion. Uniqlo signed a lease, and we're going to see a couple more probably that are going to sign in the upcoming months.
Let's talk a little bit about Market Street. I mean, we'd be sort of remiss not to mention kind of what's going on there. Walk us through kind of what are some of the things that you're hoping will happen there, and things that we might see in the near future.
Well, our real hope is that the street is opened up to cars. From a retail perspective, that changes everything. It gets people. There's over 5,000 hotel rooms on Market Street. At one point, Uber and Lyft couldn't even service them. It was only Waymo. So we're happy to have Uber and Lyft on. We love everything about our government. Our local government's doing everything they can to make the street better, but we would like to see the street open. We learned that from Valencia Street. Valencia Street had a 17% vacancy when the bike lanes were there. And it's down now, since they've been gone, it's down to like 8 or 9%. So it still has ways to go, but the proof is sort of in the pudding. And we're excited to see more daytime population on Market Street. Many of the new developments that were built over the last 5-10 years have increased their occupancy. The city's moving in at 1455 Market, which is, eventually I think 900,000 square feet of daytime shoppers. So we want to see more bodies in general, and we want people to be able to get there, and we want our brokers to be able to get there to lease space. So
yeah, is San Francisco Center or the former Westfield Mall there, is that kind of like scaring people still, or people are excited to kind of see what comes out of it, and it's independent of kind of what others are trying to do there?
I think the reality is San Francisco Center is quite a few years away. It needs to be reimagined. I think our team believes that you can't just go fill it again with new retail. It needs to be a different type of retail, and potentially it needs to be cut up in a few different ways, and maybe repositioned to include other uses. So San Francisco Center, we think it's quite a ways away, but it also has some ground floor retail that faces Market Street, so those spaces could be activated on a shorter, in a shorter time frame to just continue to keep the continuous flow while the larger projects, being envisioned.
We're seeing formula retail change recently. Tell us about that, and sort of, are you excited about this? Is this going to be good for retail in the city?
We have mixed feelings about it. We're not really a formula retail firm. We want to see, Maven believes in the right tenant. Sometimes the right tenant is a formula retail tenant. Sometimes the right tenant is a local business. And Van Ness, they lifted all the bans on formula retail. We really haven't seen that lead to a whole lot of transaction. But there are some other things that are happening. Potentially spaces that are over 10,000 square feet might have formula retail bans lifted, or the conditional use ban lifted, which will do wonders for grocers and not many pharmacies in the market, but grocers, fitness, etc. That could take those spaces.
Yeah.
What I would say is we're not in favor of opening doors for a lot of fast food. We don't think that really does. Well, it's okay to have some share of it, but what we don't want to do is just open the door. Fast food could just come in and take all the space on Van Ness without an issue. So we want to make sure that we have some oversight on the fast food.
Yeah, makes sense. AI has been gobbling up office space, and we'll talk about leasing here in the next panel. Really quickly, what does that mean for retail? Are you kind of seeing a concentric circle of sort of activity around where these companies are based? What do you anticipate will happen there?
Yeah, I mean, with retail, you definitely look at where these companies are based, but you also have to look at behavior. And one of the things that we've researched and found with AI workers is that they depend on efficiency and convenience. They really focus on their work, and their work is a big part of their life. So they want convenience. They want a grocery store within reach with prepared foods. Doesn't need to be a large Whole Foods. And so what have we seen? We've seen Buy Right expand. We've seen Luke's Local expand, Gus's, etc. Sort of smaller, higher end. I would say maybe healthier grocery store. They're into health. Fitness is nearby. We're seeing more fitness come into the market. That's strategically locating itself to cater to that industry. And then we're seeing an increase in events, which events and restaurant meals tend to be more of a gathering space for them to share ideas and develop new ideas. And so we're seeing the food and beverage industry benefit from that as well. So it's very behavioral as opposed to just location.
A quick follow-up on that. I mean, the city has done a lot in trying to kind of engage sort of an active environment, within certain neighborhoods. I'm going to butcher this, but I believe the city approved kind of this entertainment zone, right? Did that have a positive effect? Is that sort of part of what the city's trying to do also with sort of some of the activations with some of the landlords? Are all of these activities that I think the mayor's office is conducting, could we do more, or is what they're doing been really great so far?
Our feeling with that is, and this is why we support the city, is it doesn't really matter if it works or doesn't work sometimes. What matters is that you have a city that's making an attempt to do something. And they're really trying to make, if the entertainment zones work, great. If they're challenged in certain areas, let's try something else. Well, they're trying the what are they called? The night markets. Night markets tend to work in some areas, some they don't. they're putting money into certain grants and incentivizing smaller businesses to take a chance downtown. And it's like some of that's working, some of it's not. And it doesn't matter so much that it's working or it's not. What matters is you have a city that is really creative and pushing new ideas out and trying to make something happen. And unfortunately, we have media that gives them a hard time for trying. And it's like the city is doing their share.
Not this media, Santino. I'd like to point out. As my final question here, I've asked this question from everybody. Tell us, what are you looking for in kind of the rest of 2026 and into 27? What are some of the things you'll be paying attention to?
26 and 27, we're going to be always pay attention to the local operators. San Francisco is it's a breeding ground for brands. We've had so many amazing brands come out of San Francisco. We're always looking under rocks. We're always trying to find the next, the next big chef, the next big retailer, to not only, get them established in our market, but also share them with another market. So we're always looking for that next, the next big thing, and hopefully it all continues and coming in from the San Franciscans.
All right. Well, Santino, thank you so much for your time. Really appreciate it. We're going to get Roman Adler here going. Roman, let me see if I can quickly. Oh, perfect. I can quickly update your name here. So we have that correct. Roman, are you able to hear us? We may have
There we go. Can you see me? Can you hear me?
Yep.
Great.
Good to go. Good to go. Awesome. Well, thank you for your patience. Thank you for being flexible here with all of these issues that we've had with tech. Really appreciate it. You're going to talk to us about leasing in San Francisco, which I think has been one of the most remarkable recovery stories, perhaps in the country. I'm going to ask you the same question I've asked everybody else. Give us kind of a quick overview of 2026 first half of the year and kind of what's exciting and what are some of the big drivers there.
Sure. So, I mean, I think as those who have been involved in the office leasing world have certainly experienced, hopefully firsthand, or if not, are hearing about is the amount of leasing velocity that we've had so far in 2026. I mean, Q1 was upwards of 4.5 million square feet of total leasing and 1.5 million of positive net absorption, both of which were all-time highs for San Francisco. So, arguably the most active leasing quarter ever, which is quite striking when you've got a vacancy rate in the high 20s. We're just scrubbing our final Q2 numbers, and those are going to be similar. Maybe not quite as high, but not far off. So we're, and our demand continues to remain really strong. Sort of hovering between close to 9, but sometimes peaking up towards 10 million square feet of active demand, which is also an all-time high. To give some context as to where we were pre-COVID, we averaged in the 4 years, 2015 to 2019, about 6.5 million feet of demand. So we're greatly outpacing that, and we were peaked going into COVID at just over 8 million. So again, we're kind of at all-time highs for demand and for total leasing velocity. And which is great. The supply side, we're coming from a place that was really challenged of north of 30% available market wide. I mean, close to a third of the space in the market was available, and a lot of that was vacant. So we're starting to make a dent in it, but we do have a ways to go to get down to 10% single digit vacancy again.
Yeah, I'll zero in a number that you mentioned. You said vacancy still or availability, whichever number we want to use, is hovering in the high 20s. But you mentioned that you and your team literally went building by building and landed on kind of the real number, which is a lot closer to maybe the mid-teens here, right? Walk us through how you came to that figure and sort of what were some of the obvious things that came out of that research.
Sure. So we looked at the whole market, which is about 630 buildings that we track. and kind of, I think all of us who are in the leasing world have felt this for a while. I mean, since really the beginning of 25, when things almost shot out of a cannon in terms of activity. Took a little while to cycle through and start to get the deals done, but we were feeling the initial signs of that in early 25. And so, but we said, okay, well, this still doesn't make a ton of sense. It feels that active, but there's high upper 20s availability. And so again, we went through and we kind of said, okay, things that were we took out buildings that were in locations that were very challenged, where we weren't seeing much demand. Took out buildings that were really on the true commodity side of things that weren't seeing a much of demand. Took out buildings where due to a capital stack that might be upside down, they were in a position that it was going to be tough to transact and weren't seeing much demand because of that. And finally, which I think is important, also took out buildings where there was a real, true pending activity, where we expected that building was not really open to lease to new tenants because they were finalizing a deal. And when we stripped out all of that, we got down. I mean, the short of it is we got down to what a market vacancy of more like 15%, which I think makes sense. And again, for all of us on the ground, is kind of feels more like what we're experiencing in real time with competitive situations. The amount of touring velocity, deal velocity we're seeing, and where those deals are going.
Yeah, and we've seen in the first quarter something like 4.5 million square feet of gross leasing, about 1.5 million of positive net absorption, which you said historic highs, right? What do these deals look like? So how hard was it to get them done? If you can give us some insight into the mindset of a landlord and a tenant.
Yeah, the short answer is they're all over the board. I mean, it really depends on the type of building, type of space, type of tenant. Certainly, to capture the younger tech startup type of activity, which there's a lot of, those deals are still typically shorter term. The terms are starting to expand. But often shorter term, sort of plug and play, ready to go space, and frankly, a number of them are furnished. We're all spending more time dealing with furniture than we ever had, and that's a result of a lot of things. But I think probably the top thing is speed occupancy, where these tenants are kind of entering the market thinking, oh, I really want to be in space in the next 30 to 60 days, and don't have time for a build out, might not have time to even go procure furniture. So those deals are still looking like that. I think that the cost of construction is still a challenge. To build out a mid-level kind of tech open plan office space is still typically north of $200 a foot, often north of $250 a foot. So if the space needs that full construction, who's going to fund that? How does that make sense? Tenants are still very wary, though some are starting to willing to come out of pocket for some build out, but often look to the landlord to say, hey, if you build this, I'll make a deal with you. But I'm not comfortable looking at shell space, and that's reflected in if you look at the vacancy rate for space that is shell or needs a full build out, it's up north of 40%. I think mostly because of the cost to build it out and the time to build it out. But not to say that shell deals aren't happening. For the right deal, for the right tenant, especially the more established tenants, the bigger deals. Those tenants are going through even the tech side. Even some of the leaders in the AI space, the Anthropics, the Databricks of the world. They're going into spaces that require full build out and are signing longer term deals, getting a significant TI from the landlord, but also putting their own capital in on top of that.
The trophy tier seems to be doing fine. It's tight, and the pricing is above 150 from what we understand. How is that spilling into this sort of next tier? Kind of more core Class A, B plus, and B tiers also.
Yeah, I think it's definitely having an effect. I mean, as you said, the trophy sector is performing extremely well, frankly, significantly stronger than pre-COVID. And the fundamentals on the supply side support that. I mean, if you look at total availability in the trophy sector, it's kind of it's approaching 10%. And then if you think about the view space in the trophy sector, it's getting close to low single digits. I mean, I think it's at 6%. We track it at 6%, and with a and continuing to compress. So what that's doing is, especially for those tenants seeking trophy views, they might not be able to find it. It just might not be there and available in the market, a space that's suitable for them, or they might get priced out. They might not be willing to pay 150 plus. And so I think that's adding a good amount of demand to that next subset, sort of top tier Class A, but not quite trophy. And we're seeing some relatively significant rate appreciation in that class of buildings, especially towards the upper half of those buildings where they have a view. I mean, San Francisco has always been a market that views garnered a significant premium, and I think that's never been more the case than today.
Talk to us about the big blocks. So based on some of the numbers, I don't know if these came from you or from some of the research that we've done. So 52 blocks of space that are 100,000 square feet and up. Sounds like around 30 or so tenants are chasing them. How is that impacting the market, and is that something that you would characterize as being dynamic or kind of run of the mill?
No, I think I think that was all sectors of our market flipped on its head, during COVID, but that was one that flipped quickly and aggressively in that, 2019 landlords were trying to aggregate space because there was such a need and a tight supply of big block space, and there was such a premium to be paid and typically a stronger, larger tenant to lease to. That flipped on its head, obviously, and at one point I think we were north of 70 blocks of 100,000 feet and up across the market, which was significant, and probably realistically less than 10 tenants chasing those. And now that dynamic is, as he said, it's more like we're at 52 blocks that we're tracking over 100,000 feet and between 25 and 30 tenants chasing that, and with some significant pending demand. So one tenant for every, or two spaces for every one tenant isn't a terrible place to be from a big block dynamic. And some of the landlords and some of our clients are kind of considering holding off on leasing smaller portions to keep a large block intact, to try to capture that demand, because typically, not all those tenants, but again, typically they tend to be stronger credit tenants and willing to sign sort of longer term deals than some of the smaller, call it single floor type of tenants.
Right. Talk to us about the B and C product. What do those landlords have to do to attract folks into their space?
Yeah, that's as you get into the more commodity, subsets, that those are certainly where the market is still much more favorable for a tenant. There's cheap deals to be had and harder to get leases done. That being said, those landlords that are, kind of like we talked about earlier, that are getting their spaces ready for occupancy, so building it out, whether that's, depending on the existing condition of the space, but making improvements so it feels move-in ready, furnishing, getting aggressive to still capture that segment of the demand that's looking for a low-cost deal. There are deals to be had. I mean, we've got a couple of buildings that fit more into that category, and they're smaller kind of format buildings. But I think, I'm thinking across two buildings that are about 100,000 feet each, we've probably done 8 or 10 deals in both since the start of the year, mostly with tech startups who are saying, great, I can go in, I can come in, still do a short-term deal in this furnished space, and we've seen rate appreciation in those, not just leasing velocity. I mean, it's still in the lower tranche of the rent profile, so certainly depends on your basis as a landlord if that is a accretive strategy. But if the basis can support that, we're seeing it in a good number of buildings, and those that are doing it are having a lot of success. And I think, but those that can't chase those deals for one reason or another, it's really hard to then find a tenant.
Yeah, makes sense. Another kind of positive aspect of what's happening in the market today is the sublease space has decreased quite a bit. Something from like about 10 million square feet at its peak to just over 3 million, which I think you said was below that's around or below pre-COVID numbers, correct?
Yeah, so we went into COVID with about 3.5 million feet of available sublease space. We peaked, like you said, I can't remember exactly which quarter, but we peaked maybe in 23 at about 10 million feet, significant amount of available sublease space. And now we're just under 3.5 million. I think we're tracking about 3.3 million. There's also some relatively significant transactions that are pending. So in the next 60 days, we should be below 3 million. And you know, there's probably some obvious reasons why there's been good velocity in the sublease space. Again, typically plug and play, ready for occupancy, sometimes shorter term. Some had discounted rents, though the days of a quality sublease with a significantly discounted rent are in my opinion, somewhat over. And so that the tightening in the sublease market and the availability of the sublease market is certainly bleeding into the dynamics of the direct market.
Yeah. So the obvious question is, do you foresee this impacting the market in Oakland? That's always kind of a big question. Once sort of San Francisco gets hot, you know, does it begin to impact some of the surrounding markets?
Not yet. I mean, I will say we just have not seen a significant, you know, pull of a tendency that is asking about Oakland with any sincerity. I think there's enough availability still in San Francisco. I mean, you know, with all the positive momentum, we're still mid-20s availability. That's going to have to get, you know, overall, that's going to have to continue to get tighter. I think in conjunction with, you know, one of the things we haven't touched on, but everybody I think has touched on in a way, is just sort of with the new administration that came in and some of the changes made in city governance, and what we've seen on kind of at the street level has certainly helped the market. It's not all just been the fact that there's growing AI companies in San Francisco, though that's had a huge impact. And I you know, we haven't seen that yet in Oakland. So
Yeah.
if that can improve, then sure, it may become a good outlet. I mean, you know, it's always important to remember Oakland's a 12-15 minute BART ride away from Market Street and the core of downtown, and certainly, you know, as we're hearing, the residential is starting to see the spillover, so there may be the employees there. But I think until there's a little improvement on the ground there in conjunction with continued tightening in San Francisco, we just haven't seen it yet.
Makes sense. And as we close our conversation here, Roman, my final question is, you know, what are you looking at? You know, how do you think, 2026 plays out for the rest of the year? What are some of the things that you are going to be looking for in 27? You know, are the IPOs going to, you know, drive additional demand from, you know, kind of a proximity effect? You know, those are some of the big questions.
Yeah, I think that certainly is going to have an impact, and potentially an outsized impact. I mean, if you think about it, there's $4 billion plus or minus of liquidity that's going to come back into you know, Sand Hill Road in the VC world. That's going to trickle back into the market that tends to be very focused on San Francisco itself, and reinvesting in new younger companies. And also those, you know, employees who've done really well and now will go off and start their own thing. And you know, we've already started to see that, but I think we will continue to. And I think that is going to lead to one thing that we've seen, which is over the last 18 months, sort of the replenishment of the demand. Whereas anytime a larger tenant or a couple larger tenants sign leases and we think, okay, maybe there'll be a slight downturn in demand just because some of that demand has worked its way through the market, they tend to get backfilled by another group of growing tenants. And so that demand between, you know, 9 and upwards of 10 million feet has remained relatively consistent for 18 months, despite a lot of leasing, as we talked about. So we're projecting that we're going to continue to see that. I think the other two things I'd offer are, want to see some of the tenants that have leased a significant amount of space for growth, that, you know, to fill that space. Will they do it, right? Or is there any risk that there was any over leasing? Thus far, you know, those tenants continue to seem to be hiring and putting bodies in those spaces, but it's still early. I mean, a lot of those leases were recently signed and tenants either have just moved in or haven't even moved in yet. So we want to always watch that to make sure that there wasn't sort of over leasing done. And then the other one is the continued sort of reintroduction of some of the larger, more established tech companies, and when and how will they continue to re-enter the market? And we're seeing it. I mean, there's a handful that are out there active right now, some pending deals that some of them publicized, others haven't, but where some of the, call it mega cap tech companies are ready to kind of reestablish themselves in San Francisco, and we haven't really seen that since 2019. So that all positive things, but I think will be good in conjunction with the younger growing tenants who are continuing to take down big chunks of space.
Wonderful. Roman, if I can have you just hold on after I stop the webinar, just so your stuff is uploaded. But I want to thank you, and I want to thank your colleagues for joining us. I will also want to thank Alliance Roofing for being a sponsor here. Everyone have a great rest of the week.
Thanks, Vlad.